Thank you so much. I'm really honored to be here on this panel with incredibly talented and wonderful people, and to be in this room with, I feel, has a lot of intellectual horsepower. And I think we'll be using it over the next couple of days to really build a collective learning lab, as I like to think of it, for ideas around innovation in policy and institutions. And so I want to begin by focusing on the issue of financial innovation and inequality. This is a very new area for me, and I got involved because I felt that I didn't have enough knowledge to make sense of the profound changes going on in the world. I knew a lot about product markets and labor markets, but not really financial actors. And so my attempt is to kind of put this story on the map, and really this is very much work in progress. So I'm going to draw on what we learned from the private equity book, but then move beyond it to flesh out some of the implications in the non-financial firms, more general in the economy. So I want to start with the observation that there has actually been a decrease in inequality across countries, but an increase in inequality within countries. And in our field, we know we have explained a lot of this because of changes in deregulation, technology change, globalization of labor markets, product markets, et cetera. And that has put downward pressure on wages and working conditions and social protections in the core of advanced economies. But I think we've paid less attention in our research to really understanding the financial actors in the financialized firm, as Glenn mentioned earlier. So I'm going to focus at that more firm level and flesh out some issues. There's recent research in the US that shows that over half of the decline in labor's share of income is due to financialization, over and above that due to deunionization, deregulation, globalization. And so this makes me think about, at the same time that we need to really be paying attention to global supply chains and globalization, we also need to focus on what's happening within the country. And particularly, there are financial actors that are affecting service industries that are not really yet traded: healthcare, hotels, hospitality, restaurants, et cetera. And so there's another dynamic, and this is where I think financialization is particularly important in that play. I'm going to invoke a phrase used by anthropologist Laura Nader, who is a dear someone who I looked up to in the 70s, which he said we should be studying up. And so we should study the top in order to mobilize the bottom. And so that's the kind of spirit of this talk today. In focusing on financial strategies, I'm looking at the change from what we all know as a kind of managerial model of the firm to of a financial model. We know that in the managerial model, wealth is created and extracted primarily through the labor process, through production processes. And so the importance of labor bargaining and the labor management relationship is really central. And what I want to argue is that when we move to a financial model of the firm, a couple things happen, but importantly, the labor process has a diminished role to play in capital accumulation. And there are many, many more ways of making money than negotiating with labor. And to give a couple of examples from private equity, which is kind of the lead example, in a financial model, there's much more, obviously, speculation and manipulation of stock share prices, innovative uses of debt and other financial tools, buying and selling of companies, buying and selling of assets, selling off profitable divisions, rather than investing in them, outsourcing lower value-added production, engaging in fee-generating activities and financial transactions, engaging in tax arbitrage. So that is the kind of financial model of the private equity firm. And now what I want to play out in a few slides is how that may be spilling over into non-financial, publicly traded corporations. And so this is, I'm not going to mention opportunities for institutional change, because I think we have to do this kind of analysis in order to identify where the opportunities are, and then use those points to leverage change in policy based on our research analysis. There are two dimensions I want to emphasize. One is the distribution of gains from productivity from workers to elites, and the second is the shift in how firms make money. So with that, there are a couple slides I'll show you. This is a well-known slide in the US which documents the US productivity wage gap over the last 65 years. It's by the Economic Policy Institute. And 3 points are important. The first, oops, not that way. The first is you see this general increase in productivity over 65 years, a massive increase in productivity in the US. Second, you notice that wages keep up for workers until 1973, and then we have this massive divide, and this represents the hourly compensation of non-supervisory workers, and this is the gap that I think we have to explain. We kind of flag financialization, but we need to understand the particular organizational mechanisms through which the wealth gets transferred to the elites. So what are these mechanisms? Well, one that we all know, but maybe I want to emphasize it, is the shift to stock option pay, which exploded in 1990 when Michael Jensen wrote this very well-known article in HBR. And what we see is this is the CEO worker pay ratio since 1965. It's at about 30 to 1 until the late 80s, and suddenly it explodes in the 90s and then swings with the recessions in the 2000s. But that is largely due to the shift to stock option pay and capital gains that the CEOs make. And this actually understates inequality because it does not include things like inherited wealth or dividends, et cetera. This is just at the level of the firm. The second point I want to make is that once you have CEO pay tied to the stock, and because performance is based primarily on the stock, the financial model builds in incentives to manipulate stock, right? And if we look at this as the work of Bill Lazonick, who's been fabulous in this. He traced 450 companies over the last 10 years, and he found that the stock repurchases average 51% of net income of these companies. These are our leading companies in high tech, where we expect innovation to be occurring. Then if you look additionally, dividends average 35% over this period. So 86% of net income is going into CEO stock and dividends, leaving very little to be reinvested in the so-called innovation firms that are going to build our knowledge economy. The effects, of course, are not only increased inequality, but because of less investment in innovation and skills, et cetera, we don't know what the viability of those firms is in the future. So this has kind of a long-term systemic story to it. So that's two of the kind of key innovations, if you will, that are driving a lot of the inequality. Now I want to switch to the kinds of alternative ways that companies make money. So think about it. If you are basing your performance on stock, you're tying CEO pay to stock, you're repurchasing and giving out dividends, where does the money for innovation come from if you want to invest? Well, it comes from debt. And so the corporate use of debt to finance capital investment has dramatically increased. And this has certain repercussions. We look at the ratio of debt to capital. Historically, it would be about 30 to 70%. In the 2000s, in US corporations, it's nudging up to the 40%. In large multinationals, probably closer to 50%. The ratio in private equity firms is typically 70 to 30%. At that rate, private equity-owned companies have twice the level of bankruptcies as comparable firms. So bankruptcies can be, the financial kind of instability of that much debt is a very serious concern to companies, and we see non-financial companies moving in this direction. So why are they doing it? Well, first of all, the interest rates are at historic lows, which of course is government policy that we could do something about. Debt multiplies returns, right? If you, the denominator is lower, how much you have to put in to get that kind of return, and interest on the debt is deducted from taxes, and so there's another kind of point of leverage we could look at in terms of policy change. Now here is another kind of way of making money, which is the idea of buying and selling assets. If you view the firm as a bundle of assets, then clearly you want to buy and sell a lot of them. And so one of the key things that has been in the private equity model is to buy asset-rich companies, essentially divide the company into a real estate and operations company, sell off the real estate, and force the operations company to buy it, to lease back the land it used to own. Now, historically, companies have kept property to hedge against downturns in the economy. So if you have your own property, you don't have to worry about rent and you make it through. We have many examples of companies that where they sold off the property, they didn't survive the recession because they had to pay rent. They had to pay inflated rent. We're now seeing this, some of this in large non-financial companies. Darden's is an example. Last summer, where hedge fund activists went in, they insisted that it's the largest restaurant chain in the world, and insisted that it take its property and essentially sell it off. And the outset was that it managed to sell off only 500 properties in one chain rather than all of their properties. And that money was used essentially to finance a private equity deal. But just in the 3 months of 2015, there are 28 activist hedge funds who are demanding this of European companies. Hedge funds asking for both share buybacks and the selling off of property. Another one is the selling of less profitable divisions. So in the managerial model, you're competing in a product market, and you need to kind of stay in there and compete and figure out ways to innovate and make money by your improvements in performance. In the financial model, anything that looks like it's not doing so well, you just sell off. This was kind of Jack Welch's model. This is definitely the private equity model. And in our research, we found that 2/3 of the productivity improvements from private equity were due to selling off less well doing plants and then buying greenfield plants. So it means it's a model that is not based on reinvesting in what you have. Another one is shifting production to suppliers. We have referred to this as the core competency model, and we know a lot about it in terms of global supply chains. The research on how this works within countries is really undeveloped. We've been appalled. I've been looking at it in the US, and it's amazing how little we know. So we know much more about global value chains, and there's a really important role for us to look within our countries at service and logistics and healthcare and a variety of service sector places where this fragmentation is occurring. It is the same logic of letting go of less valuable types of work. And then finally, this is Krippner noting that the financial activities as a percent of overall portfolio companies doubled from 1980 to 2000. Okay, let me just go to, I think I only have one more slide, and I've got 5 minutes, perfect. So tax arbitrage and subsidies. Now, everyone has always tried to get out of paying taxes. So the whole question is there something new here, right? And I think there is. So corporate contributions to U.S. taxes as a percent of U.S. tax income dropped from 32%, excuse me, to 10% over this period. And there were several ways that this happened. So here are a couple. One, this debt used to finance capital investment is then deducted from, the interest is deducted from taxes. The companies now are also financing their foreign operations, but then putting that debt on the U.S. books so that it can be deducted from their U.S. taxes. There are also, we all know about offshore subsidiary tax havens, about $90 billion a year in losses. Accumulated earnings now held offshore, they're not being repatriated, is about almost $2 trillion. And then corporate inversions is a kind of new tactic where companies actually renounce their U.S. citizenship, locate abroad, and then don't have to pay taxes. And there are about 50 companies, 50 major corporations in recent years that have moved in this direction. Okay, so now I want to just return to the questions that I asked originally and suggest, you know, what are some rich avenues for studying up? What could we do as a research community to study up and then identify points of leverage for making policy and institutional change? And, you know, I've only given very illustrative examples in this short time, but clearly I think we really do need to pay attention to the financial strategies of non-financial companies and map that out and see how it varies across different industries, different occupational groups, different countries, because we can see we may be able, it may be, you know, concentrated in a couple of industries, like in low-wage industries and highly franchised industries. And then we can target regulation at those particular sectors in order to make change. We need research on mergers and acquisitions and how that churn is affecting the instability of jobs and employment in the economy. We really need value chain analysis on domestic companies. We can learn so much by what we've done at a global level, and now I think we need to do the same in our own countries to see and make comparisons along those lines. But beyond the non-financial sector, I think it's really important that we study up the financial sector in two ways. First is all of the ways in which the financial sector affects the non-financial sector in terms of its strategies. But second, the financial sector is a place to work. So what do people do? How is work organized? Is this work really value creating? It's the productivity, like transaction fees, the accelerated use of transaction fees is counted as contributing to GDP. But is it? And how do we flesh that out? And then finally, a couple of ways of thinking about this is to really explore alternative investment vehicles, and I know there's some sessions in the next couple days on that. We could look back at community and cooperative banks and see how we could get them to scale, how they can be more useful in the economy. We can look at union and public pension funds as a source of workers' capital, but we've been saying this for a while, and there seem to be institutional barriers to their use. And in fact, in our research, we find in the US that 35% of investments in private equity is done by unions and public pension funds. So there's an institutional problem here. Why is that going on, and how can we resolve it? So in summary, it seems to me that this kind of community is the best one to do qualitative field research on organizations and institutions to really find what is going on in terms of the financial mechanisms and how they work in different types of firms, in different types of industries and countries, and that will then provide a research base for making informed policy and institutional change. Thank you.